Welcome to the Lend Academy podcast, episode number 225. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's episode is sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech, lending and banking connected. Go to lendit.com/USA to register. Today on the show, I'm delighted to welcome back Noah Breslow. He is the CEO of OnDeck. This is actually his third appearance on the Lend Academy podcast. He was on in 2014 and 2016. But wanted to get him back on because there's a lot that's happened in OnDeck's world. They've become profitable. They've announced they're going to apply for a bank charter, which we talk about in some depth. We also talk about their lending business and how they're growing that, how they're competing against the likes of PayPal, Square, and Amazon. And we talk about transparency and the Smartbox initiative, and we talk about ODX and the bank partnerships that they have. It was a fascinating interview. I hope you enjoy the show. Welcome back to the podcast, Noah.
Hey, thanks so much, Peter. Great to be here today.
Okay, so you actually have a distinct honor today. You are the very first person to appear on the Lend Academy podcast 3 times, which obviously speaks to your longevity for one thing. And so maybe we get started. Maybe you could just, what do you think is the secret to your longevity in your job, given the fact that obviously many of your compatriots, fintech CEOs, have come and gone during your tenure. So why do you think you're still, you've had such good longevity here?
Well, first of all, that's really cool to know that I'm the first person to appear 3 times on the podcast. That's a great honor. Thank you for having us back.
Of course.
The longevity thing is interesting. One of my board members, I think, summed it up reasonably well. She said that I guess I'm adaptable. And I think when you look back over the 12 years of OnDeck, we've had to adapt. When the company started, back in 06 and 07, we immediately had, kind of a huge economic recession. We had to adapt to that environment. Then kind of our hyper growth years, we sort of adapted to that model, raised a lot of capital. We're able to scale the business. Then, as I'm sure we'll get into, we went public and had to sort of adapt once again to becoming a profitable financial services company as opposed to sort of a hyper growth, privately held company. And now I think, we're starting to reap some of the benefits of that decision to get profitable. And so, I guess, at one level I'm adaptable. 2, it's no secret I love what I do. Love the folks at OnDeck and the team that we've built here. I love the mission that we're on. I love working on small business lending. I think it's a really important thing to solve in the economy. And so I guess I feel honored to have been able to serve this long, and hopefully we'll get to continue to do so in the future.
Yes, indeed. So you just touched on it, but one thing I want to get right off the bat here is next month is 5 years since you went public, and obviously it hasn't been all smooth sailing, but I'd just like to get your perspective on if you take yourself taking back 5 years, knowing what you know now. Would you have done anything differently back in 2014?
It's a great question. And certainly one I ask myself periodically. And so, hindsight's always 20/20, but I go back to a couple things. One is, some advice we got from someone in the industry before we went public, which was that the category leaders, it doesn't matter what industry you're in, generally go public eventually. And so we always felt that OnDeck was being built to last, versus being built to sell. And we had several opportunities to sell the company when we were a private company, and we passed on them because we really felt and believed in the long-term vision of what we were doing. So I think if you believe you're building a company for the long term and you believe you're one of the leaders in your category, going public is probably something that you eventually do. Of course, we've learned things in the last 5 years, and I think chief among them are the way we positioned the company as we went public. So we went public, with more of a technology positioning. But at the end of the day, we're a technology-driven business that has a financial services business model. Almost all of our income comes from lending, and not just lending, but really spread lending, right? We retain the risk on our loans. We maintain a balance sheet. And so, I think our positioning there and our valuation probably should have reflected the financial services nature of the business a bit more than it did. That was sort of really lesson one. Lesson two, I think, is just sort of the stage of where the company was when we went public, in that, we were still loss-making when we went public. And as we've learned, once you get the company profitable, a lot more of your value as a company can be in your current year financial, metrics, as opposed to some long-term, point in the future where an analyst models that you'll turn profitable. And so when you have that, it can lead to a lot of volatility in your projections and your stock price. And so, that being said, we were able to raise, over $200 million for our balance sheet, at an attractive price. And, we haven't had to raise equity in 5 years, nor do we expect to in the future. In fact, we're actually buying back our stock now, given our level of profitability. And so I think ultimately it made the company stronger, a better run company, more disciplined. But certainly, I don't want to claim the last 5 years have been smooth sailing. They obviously haven't, and there's something we can learn from that.
Right. And yeah, speaking of profitability, I think it's one of the knocks on the fintech lending sector is that there's a lot of loss-making companies out there. And, I know that you guys really switched focus to profitability. I don't know, it might have been 2 years ago now, but you're certainly ahead of the game. So what do you think, what was the driving forces that that put you over the edge towards profitability?
Yeah, I think a couple things. We did change our capital market strategy in 2016. So that's call it 3 years ago now. Where we had gone from a hybrid model of selling some of our loans off balance sheet and holding a good amount of the loans as well, to a model where we held all the loans. And that was the first step, I think, in stabilizing the business model. When we had been selling loans off balance sheet, there were gain on sale, amounts that would change quarter to quarter. There was credit demand that was a lot more volatile quarter to quarter. So that was sort of step one towards getting the company, I think, more stable. And step two was in 2017, which is probably the hardest year we've been through in the 12 years of OnDeck, which was, we made the decision to restructure. We laid off a percentage of our staff and really reduced our expense base. And we sort of set a goal in the beginning of 2017 to get profitable by the end of the year on a true GAAP profitability as well, not an adjusted EBITDA or non-GAAP metric. And we achieved that. But it wasn't without cost. It was a painful process to go through, and we learned a lot of lessons about the company and about leadership through that. But I think it was the right thing to do. As a lending business, ultimately you have to be profitable. You have to be growing book value and your equity base, quarter over quarter. And I will say it's really paid dividends now. Our cost of capital as a borrower in the capital markets has come down, partially because of that profitability. We made our first acquisition last year, partially because of that profitability allowed us to do that. And I think you'll see us make more moves over the coming years where we leverage the profitability we have in the business to expand and grow.
Right. Okay. So I want to dig into your lending business for a little bit here, and maybe we just get started. I mean, you have your term loans, you have your lines of credit. Maybe you could just tell us what's the rough mix today between those two products?
Yeah, so the rough mix is, I think it's 78% of our book is the term loan product today. About 22% of our book is the line of credit product. Okay,
and the term loan, what's the sort of average of the term loan? How long do you go out on average?
Yeah, so on average, our term loans are right now hovering around 13 months. That's kind of a dollar-weighted average, not a loan-weighted average. Right. But we go from 3 to 36 months in terms of range. But really, the majority of the OnDeck offers and what customers are looking for from us today are really between 6 and 24 months. That's kind of the vast majority of the portfolio.
Right. And I mean, let's talk about underwriting. How has your underwriting changed, or has it changed much this year? And are you tightening things up in preparation for maybe a turn in the credit cycle? Where are you at with that?
Yeah, no, this is all in our earnings calls, of course, but we did make some changes earlier this year. So we pulled back a bit based on some, kind of signals we saw in our data early in the year. And I would say that, we were a little bit ahead of the curve on that in the sense that the Fed at the time, people thought the Fed was going to be raising rates all year. And it turns out now we've lowered rates, several times this year. And so I think we did see some signals in the economy that eventually were picked up in other places. And what we've now been doing for the last sort of 4 or 5 months is really focusing on what we call our offer quality initiative. So kind of focusing in on the top third of borrowers that we approve and basically offering them slightly better loan amounts, slightly longer terms, slightly better pricing, And I think on the margin, trying to increase our dollars in the portfolio from that top third of borrowers. And so as a result of that, the average FICO score in our portfolio has never been higher. We just had a securitization price last Friday, and that securitization is the first actually AAA rated securitization in the online small business loan market. So, the rating agency, I think, picked up both on the company's profitability and on the improved quality in the portfolio. And so I think it's a great position for us to be in kind of late in the cycle. We obviously are cognizant of where we are. We don't know when the downturn will happen, but it definitely will. And so we think really focusing on our best borrowers is the right move right now.
Right. Of course, you could be like Australia, though, and we could go 26 years, I think, since Australia's had a recession. So, you never can tell.
That is true. That is true. And I will say, obviously there's a lot of political pressure on the Fed to keep rates low, to keep the economy growing. So we are cognizant, I think the critique of what we are doing is that if in turn the recession doesn't happen for 3 more years, we're probably a little bit under investing in growth right now. Right. But obviously, in a lending business, we're playing for the long term here, and we want to make sure if a recession does happen, we're set up right.
Right. Yeah, fair enough. Okay, so the last year or two, we've seen a real surge in some interesting competitors in the space. We've got PayPal, who are doing huge volumes now in small business lending. We've got Square that are also doing a lot, and Amazon's doing some. And these are obviously big tech companies, deep pockets, and with all having some sort of proprietary access to proprietary data on the businesses that they underwrite. First, do you see these companies when you go head to head in the market, and if so, how do you compete with those kinds of companies?
Yeah, I think to answer the second part of your question, in terms of do we see them, we absolutely do. I think, not just, PayPal, Square, Amazon, but you have some online lenders too that are getting bigger themselves. And so I think you see a classic, kind of scenario where a market is maturing. So going from, call it 40 or 50 smaller players over time, it'll consolidate down to, 6 to 10 kind of players that have scale, and all of us will have different competitive advantages. I do think the arrival of the closed loop players in our market, we call them closed loop because they do have an existing merchant base and a data feed, as you noted, is probably the most important development in the industry in the last couple of years. And, I think a couple things will play out here, and we still think we're well positioned to grow and win in this market, but we obviously have to be careful where and how we compete. So, I think those players are generally much stronger underwriting their own merchants, and some of them don't have the capability to underwrite merchants that are not on their platform. And one of the advantages of the OnDeck approach is we can underwrite any small business, regardless of who they process their payments with. The other thing is we have a more holistic view of the business. So certainly, payment processing data is one data source, and having access to that helps. There are other ways to get access to that particular data set, so it's not that data is impossible to get to. 1. 2, what we've learned over the years is that no single data source carries the day. And so when you see a business that has a diversity of revenue streams and maybe has a more complex balance sheet, maybe needs to borrow a little bit more capital, I think that's where OnDeck has a real edge. We can often outlend those companies that you mentioned on sort of from a time basis, from an amount basis, from a speed basis as well. Clearly in the smaller end of the spectrum, so if someone is looking to borrow $10,000 for their business, I think that sector is now quite competitive. So the players you mentioned, all the online lenders, the pure play online lenders go after it. And to some degree, consumer lenders are going after that space as well, because a small business owner is a consumer as well and can maybe borrow from a player like a Lending Club or a SoFi or so forth. So I think that's really it. The smaller end of the market is very competitive right now, but we still feel differentiated as the loan sizes get a bit bigger and the terms get a bit longer.
Right. Okay. So I want to just talk about transparency, and you've I know you were one of the founders of the Smartbox initiative, which is giving a comparison tool so small business lenders can see the different ways that how much the loan is going to cost them. So California has passed a law to mandate more disclosure and focusing a lot on APR. So I guess, what's the impact of the California law on you guys? And then are you seeing sort of traction with the Smartbox initiative? What's going on with transparency?
Yeah, so transparency is incredibly important. As online lending continues to grow, 32% of small business owners tried an online loan. That's up in 2018. That's up from like 16% or something in 2016. So, as the industry grows and goes from kind of alternative to mainstream, the focus on consumer protection and transparency is going to be front and center. I do think we were reasonably ahead of the curve when us and the other members of the ILPA, the Innovative Lending Platform Association, rolled out the Smart Box. I think that was like 2 or 3 years ago now. So it's been out there for a while. And we were actually fairly involved in the drafting of the California bill. So we worked with legislators to educate them on online lending. We showed them the Smart Box. The Smart Box has always disclosed APR, and so we largely feel the Smart Box satisfies the requirements of the California bill, maybe modulo a couple small adjustments. So I think that's really our strategy, and I think you'll see small business loan disclosure bills, cropping up in a few other states. We have our eye on a few other states where they're kind of in discussions, and our goal really is to come in to the states to educate on the economic impact, the positive economic impact of online small business lending, and then offer up the Smart Box as a tool that could potentially be rather than inventing something from scratch, gives you a template to work off of. And so that, I'd say we've been pretty successful on that so far. And, in terms of Smart Box adoption, we've continued to expand membership in the ILPA. And we've also gotten Smart Box now in slightly localized forms adopted in Australia. Speaking of Australia, so the top 7 online small business lenders in Australia have now agreed to adopt the Smart Box, and we're working on a similar measure up in Canada, where we have a business as well. So the hope is to make it kind of the de facto loan disclosure for the industry. And I think regulators appreciate that, and no doubt it's going to be a critical issue for the industry over the next couple of years as adoption continues to grow.
Right. Okay. So I want to switch gears a little bit and talk about bank charters. So, you announced earlier this year that you were going to pursue a bank charter. So why do that, and why do it now?
So the decision to pursue a bank charter was not one we take lightly, and it was really done after several years of careful study. And because I think we had said even prior to the last couple earnings calls that we had been exploring different bank charter options. And so why now? I think, one is we're reaching a level of scale where we're really a national business, and, sort of thinking about long-term regulatory structures for our industry, we think there's some advantages to being a nationally chartered bank in terms of rate exportation would be one, in terms of consistency of laws and the application of laws across all 50 states, kind of more generally than just rate too, is another. And then, as you mentioned earlier, we're probably late cycle. We don't know when the next cycle will turn, but the stability of bank deposits as a funding source is not lost on us. And there's a long history of monoline or very limited number of product lenders turning into banks. And, rather than wait for an economic cycle to happen and kind of turning into a bank on our back foot, we felt like the company was mature enough to go on our front foot. The other part of the now gets to the readiness of OnDeck to take on a bank charter. So over the last couple of years, turning profitable obviously really improves the stability positioning of the company. All the compliance we've had to build out, being a publicly traded company and also running our ODX business, I think positions us well, to interact with regulators, in that new way. And we've also updated our management team and board of directors with a number of folks who have substantial banking experience. So Ken Brous, our CFO, who joined us from CIT, bought a bank while he was at CIT and has, 30 years of financial industry experience. We added 2 executives to our board last year as well, who have that experience. So I think the now is partially a function of OnDeck being ready, and partially a function of our scale, and I think partially a function of wanting to make sure our business is stable and a reliable source of funding for our small business customers, regardless of where we are in the cycle.
Right. So do you anticipate then being like a full service bank where you've got a whole range of different products? I presume you're going to maintain your small business focus, but are you looking at like small business checking accounts, small business savings accounts? Are you going to have a consumer element to the deposit gathering? What's the OnDeck bank going to look like?
Yeah, so we've been a little bit tight-lipped about this publicly until we're more ready to announce kind of the method and plans for obtaining a bank charter. But what I can say is, that small business focus, absolutely. That's our bread and butter. It's our core customer. And this is really about, hearing from our customers that they don't always feel well served by their existing products that are out there in the market. And small business has always been a bit of the forgotten stepchild, right, between large commercial customers and the large scale of consumer banking, right? Mm-hmm. And so we think that a digitally integrated front end that combines kind of savings, checking, and lending, and really timely lending options that can leverage some of the data that we're able to share with our customers and know about their business, we can be a better partner to them. So I think a little bit TBD on the consumer piece of this. I think, but getting back to our strategic focus, it really is on doing the best we can for our small business customers who have been somewhat underserved. So that's the thinking for now. And certainly as we get further down the road on this, we'll talk more about what our plans are.
Mm-hmm. Sure. And I know you can't really share much, but I mean, can you at least share, like, is your timetable that you had laid out for this, are you on track with that?
We are, but again, I can't say too much about the specifics. So, suffice it to say, I think it was our second quarter earnings call where we changed the public-facing language around this from sort of exploring to pursuing. We felt we kind of had to do that given how far we were getting in the process. And we want our investors and the community around OnDeck to not be surprised, if we, in the next, X number of quarters, make an announcement sort of more specific about what our plans are. And so we felt like that was the right kind of pre-signaling to do. And we are on track for our timetable. And so we wouldn't have made that change in language if we felt like we were years away from detailing what our plans are, but we're definitely not weeks away either. It's probably measured in the order of months. Right.
Okay. Yes. It's not a quick process. We all know that. Okay, so
that is certainly true. Not totally in our control either, right? As others have learned. So I think we want to be respectful to the regulators and everyone else involved.
Right. Hopefully it'll go quicker than what Varo Money has experienced, which is certainly a multi-year process. But anyway, let's talk about ODX for a second. Mm-hmm. And obviously you made a big splash. I still maintain it was the biggest partnership in the history of fintech when you announced that you're going to be Chase's partner for online small business loans. And maybe we can start off with that. So when you signed, I think it was 2015. I think it was like 4 years ago, right around now. I think from memory, when you announced that mm-hmm. Deal, did you expect it was going to last for 5-10 years? Did you feel like 4 years or thereabouts was about right? I mean, what did you think back then?
Yeah, I think both back then and until relatively recently, like, as much as, 7 or 8 months ago, we really thought it was a long-term partnership kind of in that 5 to 10 year time frame. We always knew that partnering with Chase, they are, the biggest bank, they have the largest IT budget. And if anyone was going to try to build a solution themselves over time, it was probably them. Right. But, I got asked a question similar to this a couple of weeks ago, and someone said, did you feel used by the whole experience? And, I no, not at all. I mean, even knowing what wound up happening, I would do it again. And the reasoning why is, it actually made us a better company, not only for the ODX business, but in terms of even how we operate the company today. Chase had a very high standard for compliance and data security and business continuity and, how they thought about their customers. And we built a successful program, and I think we're very proud of that. And if you look at the loss rates, the volumes we achieved, we can't discuss these things publicly. But, Chase also said in their public remarks that OnDeck was a fantastic partner and to work with. And so we're proud of what we did. I think we moved the ball forward in online small business lending, as you said, as a result of that partnership. What happened, simply put, was there was a change in leadership at Chase, earlier this year. And kind of with that is a strategic review. And I think Chase is at a point where they were either going to have to invest a lot of money over the next 3 to 5 years, kind of deepening the relationship with OnDeck, extending it to more products. That was not a small investment on their side to make. And they felt like, well, we're Chase, and the point of arrival for this, even if it's 3 to 5 years down the road, probably is eventually bringing it onto our system. So, what we learned from it, I think, is that Chase is one of the few banks in the country, I think, that can make that trade, just given the size of their technology investment. And what we learned, we've announced several other banks, PNC. We've recently announced Investors Bank. We have some other banks we expect to sign between now and the end of the year. We may not announce them till next year. But what we're learning is that not every bank is prepared to make that investment. And many of the smaller banks may never be able to make that investment on their own. And partnership really is the right strategy for them.
Right. So, that's what, do you think you need to be a top a top 10, top 25 bank to be able to really get something that is, as good an experience as an OnDeck customer gets, and with all of the, the effort that goes into that on many fronts, not just tech, it's marketing and all kinds of things. So is that
right?
Like, do you feel like what size bank do you think realistically can pull that off?
Yeah, so I would say I don't think it's limited to the top 10 or 25. I mean, there's kind of a sweet spot where you're big enough to have a customer base and a sophistication level that would allow you, because as you said, it's not just implementing the technology, it's absolutely about your credit modeling and your marketing strategy and how you approach your borrowers. But also, what we did learn with the Investors Bank deal in particular is working with a slightly smaller bank can go faster.
Right.
There are fewer committees to go through and fewer hoops to jump through to get approval for different projects, and the integration can be smoother. And so we haven't talked publicly about our timeline with Investors Bank, but suffice it to say what I did say on our prior earnings calls was the sales cycle was faster there than we experienced at the larger banks, and the time to implement will be dramatically, I think, smaller as well. So that's what we're learning. I think so. Top 10, top 25 banks feels a little restrictive. Top 100, top 200 banks feels like the sweeter spot maybe overall. But you're absolutely right. A very, very small community bank. We haven't yet modularized the OnDeck technology. And also there's a business case issue, right? How much are you going to actually be able to invest at that size of an institution to make the business case close? So I think, expanding our universe, though, from the top 10 to the top 100 or 200 will keep us busy for a few years, and we'll start with that.
Right. Yes, no doubt. So then what are obviously with Chase, the fact that you had that relationship must make all these others, even the fact that the Chase is going away, you pulled it off without any major hiccups, at least from externally. we don't hear anything. So I imagine if you've done it with Chase, people say, well, they can certainly get the capability of doing it with anybody. How much did that really, the Chase kind of partnership, drive the rest of these discussions?
Yeah, look, I think it was a big deal. It's sort of one person referred to it as the good housekeeping seal of approval, and I think that absolutely had an effect on building the ODX business up, and it's still an asset today, even though Chase is no longer going to be working with us. We're still working through a wind down period on the portfolio, but we also were very happy that our pipeline didn't suffer when we made the announcement, because that was obviously a source of concern.
Sure.
What will happen to the banks that are exploring an ODX solution, because it is a longer sales cycle, and everyone, stood firm. And I think, and that was good to see as well. So I think that's right. We, did get a capability uplift from implementing the program with Chase, and I think it is still serving us well, going forward.
Right. Okay, well, we're running out of time, but before I let you go, you have a great window into the health of small businesses, even sector by sector. I'm curious to see, are you hear about, I was listening to, I think it was NPR the other day, talking about CEO confidence levels are lower than they were, a year ago. And so I'm curious about what you're seeing as far as in the small business community. Are you seeing any hints of any pockets of slowdown, or do you feel like people are still confident and still taking out loans to buy new equipment to expand their business? What's it like out there?
Yeah, no, it's a great question, and we have a lot of data coming in to inform our perspective on this. And so what we've said, previously about 2019, earlier this year, we did see a little bit of weakness in transportation and manufacturing, and I think a lot of that was related to some of the trade uncertainty that we've had, right? Fewer imports at our ports lead to fewer goods shipped across the country, and it really hit in the transportation space some of the owner-operators out there. The spot rates went down, manufacturing volumes declined a little bit as well. And so that is, because obviously if we're exporting as well and those exports are being impacted by tariffs, could be a challenge. And so we did see some of that earlier in the year. Currently, I would say we are not sort of publicly talking about anything dramatic. We think the American consumer is still strong. And I think there's a lot of data sources that back that up. But to your point, the business climate and the business outlook is a little bit more conservative than it was last year. So if you look at there's a small business optimism index that I think is run out of the University of Michigan, and you've got the CEO temperature gauge that you just mentioned. I think, businesses are still optimistic about the future, but maybe a little bit less so than they were a year ago. And that's probably influencing demand for loans a little bit. So I think that's our read on it right now, just a little bit more caution, especially as we head into an election year in the U.S., obviously a really different set of options in front of the American populace in terms of voting. So I think you're going to see some uncertainty lead up to the election. And we actually saw that a little bit even in Australia, where there was an election not too long ago. Mm-hmm. And, there's a little bit of a slowdown in business investment right up to that election because people don't know who's going to win and what their policies are going to be.
Right. Got it. Okay. So then final question then. Looking through into the future, what's the long game for OnDeck? If we get back together, Noah, in 3 years' time, what do you hope you will have achieved?
Yeah, it's a great question. So I do think, as we talked about earlier, this OnDeck bank idea is pretty exciting. Mm-hmm. And I do think it'll take a couple years to get there because, as you noted, and there's a number of applications going through the process now. It takes a while, but we're in it for the long haul. And so the idea of OnDeck Bank being the digital bank for small business is very exciting. And we think we could spend the next 5 or 10 years really working on that vision, building it out, and just creating a killer set of tools for our customers to manage their cash flow. And when they have extra cash, we can probably pay a more competitive rate than they're getting today from their current bank. And when they're in need of cash flow for the day-to-day, expenses, we'll have products for that. And then when they're in need of cash, for investments, we have a term loan product today that deals with that. But we could also offer potentially SBA products over time, or secured lending products like equipment finance or asset-backed lending over time as well. Mm-hmm. And so my hope is 3 years from now, we have a wider, maybe much wider variety of products to serve our customers with. Hopefully we figured out how to navigate the overall bank charter process, and we've started to succeed in repositioning ourselves in the market as, hey, you knew us as a leader in online lending, but now really know us more as a digital bank for small business. And that would be a lot to get done in 3 years, but we'd be pretty excited if we did.
Okay, well, good luck with that. I know it's not going to be easy, but anyway, I really appreciate you coming on the show today, Noah.
Thanks so much, Peter. Always a pleasure.
Okay, see ya. The lines continue to blur in fintech between lending and digital banking and savings, and all these different silos of products are really, the fintech companies are now becoming diversified financial institutions. And, this is going to be a long process. As Noah mentions, getting a bank license is not a trivial process, but looking down the track, you can see that, consumers and small businesses are really going to be better served than they've ever been with these options of digitally native companies that are now well established in their sector and offering a full suite of banking services. It's a really exciting time, I think, to be involved in finance. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech, lending and banking connected. Go to lendit.com/USA to register.